DSCR loans, how your LLC can buy cash flowing property without a personal guarantee. Here's a clean, practical guide to DSCR loans and how your company can use one to buy income producing real estate without tying the debt to your personal credit. A DSCR loan, debt service coverage ratio, evaluates a property's net operating income, NOI, against its debt payments. Lenders focus on the property's cash flow rather than personal wages, tax returns, or employment income. The higher the DSCR, the more comfortably the property covers its mortgage. Why this matters: the loan is made to your company or LLC, not you personally. That can keep the mortgage off your personal credit report and avoid a personal guarantee. Some lenders may still consider personal credit to improve terms, for example, higher loan to value for stronger credit, but the property's cash flow is the primary qualification. Who benefits? Self-employed investors, people with complex income, and buyers who want to hold rental property rather than flip it. DSCR loans are designed for steady cash flow. They are generally not suitable for short-term flips that close and sell quickly. Key advantages: qualification based on property income, not personal income. Faster applications and closings because less personal documentation is required. Ability to scale: you can apply for multiple properties at once if each property's cash flow meets criteria. Keeps personal assets and credit cleaner when the loan sits with the LLC. Basic DSCR calculation: monthly net operating income, rent minus expenses, divided by monthly mortgage payment. Lenders typically require a DSCR greater than 1.0. Many programs use minimums in the 1.0 to 1.5 range depending on lender and product. Higher DSCRs support larger loans or better terms. Typical terms and requirements: loan to value commonly around 70 to 80%, so expect 20 to 30% down. Interest rates and LTV vary by lender and borrower credit. Better personal credit can sometimes increase LTV or lower rates. Lenders will verify fair market rent, often via rent schedules or appraisal. Utilities and which party pays them affect NOI in the DSCR. Structure leases carefully to reflect true expenses. When DSCR loans are not ideal: short-term flips that won't show stable 6-month plus rental income. Properties with poor cash flow or unclear expense allocations that drop NOI below the lender's threshold. How to apply: recommended process. Find lenders who offer DSCR products, not all do. Work with a knowledgeable mortgage broker to compare offers and streamline paperwork. Submit the application and provide property income documentation, leases, rent schedules, historical income if available. Lender calculates DSCR and orders rent verification/appraisal. Close if the DSCR and LTV meet lender requirements. Practical tips: verify whether utilities are separately metered or included. Shifting utility responsibility in leases can improve DSCR. Shop multiple DSCR lenders. Website examples explain terms, but rates and service vary. Maintain LLC ownership and proper entity structure, and consult an attorney/tax advisor to protect personal assets. Expect to provide a down payment. Lower down payments usually mean higher interest. Bottom line: DSCR loans let investors qualify based on property cash flow and keep borrowing at the company level. They streamline qualification for buy and hold investors and can accelerate portfolio growth when used with careful underwriting and the right lender.